Hi, good afternoon and welcome. You're watching the MF Corner. I'm Sumaira Abdi, and on the show today, first up, we're going to analyze what market regulator SEBI's order against Franklin Templeton India means for the AMC and for investors. And joining in for this discussion will be SRE's Kirtan. And a little later on the show, we're going to talk about the arbitrage opportunity. The market has been on a tear. So what does it mean for investors in arbitrage funds? We'll have Bhavesh Jain, fund manager at Edelweiss Asset Management, joining in to talk about just that. But first up, let me give you a brief gist of what SEBI's order in the FT case entails. So first up, what SEBI has said is that FT AMC, that's Franklin Templeton India, is prohibited from launching any fresh debt scheme for the next 2 years. As well, they have to claw back the management fees and the advisory fees that they have charged over the last 2 years. And this is an amount of about 451 crores, and add to it about 61 crore rupees of interest. And this interest, SEBI says, is charged between the period of that the schemes have remained shut, right, from early last year till June 7th. They say this is on, these are unjust gains. So this 61 crores is the interest applied on that. This total amount of about 512 crores will now be used to prepay the aggrieved unit holders in these 6 schemes. As well, FT also has to pay a monetary penalty of 5 crores. That's not the end of it. This is what is expected to be just the first in many orders that are going to come, because SEBI says they have already begun adjudication proceedings against the CEO, the Chief Compliance Officer, and the directors at FT-AMC. The Franklin Templeton India spokesperson said that they disagree entirely with SEBI's findings and that they will be appealing this order in the Securities Appellate Tribunal, or SAT as we know it. Separately, SEBI also came out with another order last evening, and this was pertaining to the Kudwa family. Now, Vivek Kudwa is the head of Asia Pacific at Franklin Templeton. His wife, Rupa Kudwa, who's the head of Omidyar Investments in India, the charges against them were that they had indulged in insider trading, or that they had redeemed the units that they held in the shuttered schemes just days prior to the winding down. So in their case, SEBI has said that they will be disbarred from accessing the security market in any form or fashion for 1 year. As well, this 31 odd crores that they had redeemed, 75% of that approximately has to be put in an escrow account with a lien on SEBI. Now, why 75%? Because SEBI's reasoning is that had they remained invested in these schemes, 2 of these schemes, they would have received only approximately 25% money so far, as has every other investor in those 2 schemes. So the 75% will be held in that escrow account, and SEBI will disburse it to the Kudwas only in the same proportion and at the same time as the rest of the investors get their money. So when everybody gets it, that's when they'll get it. So thereby making them just as stuck as every other investor. As well, the Kudwas will also pay a collective fine of about 7 crore rupees. Vivek Kudwa has also released a statement where he says that he's considering his options, but it is likely that he will also go the FT way and appeal to the Securities Appellate Tribunal. So this is the gist of the order so far. Let me now invite Kirtan Shah of SRE, who has tracked this case from the very beginning, to ask him exactly what happens. Kirtan, we've got the penalty part, right? What we want to know is how serious are the violations that SEBI has mentioned on, against Franklin Templeton.
Sumaira, thank you for having me on the show. So Sumaira, whatever I understand reading from the order, there are 5 things that SEBI has highlighted as major concerns or violation under the Section 11 Act. Now, out of those 5, 3 I think are very general, and probably it is very commonly used in the industry before the winding down process happened. 2 are very specific to FT. So the first one is the calculation of MAC duration. Now, for the longest time, we've seen that whenever the funds are investing in floating rate paper, the next reset date of the interest rate is considered as the maturity using which MAC duration is calculated. Now, this was the first violation that SEBI is asking FT. But in my opinion, this is something which is very commonly used by everybody else as an industry practice. And this has changed after the FT wound down process happened. The second is on the very similar lines, that because of this maturity change, what has happened is that the security valuation process or practice has got changed. And the third one, which is the scheme categorization practice, where SEBI is saying that you took a lot of credit risk while you were not supposed to do that in ultra short term kind of funds. Now, in my opinion, these three are pseudo industry practice. Everybody was doing it. It's just that after the wound down, these practices have changed. Two very specific things that are extremely relevant to FT, in my opinion, are the first, that SEBI says that you did not use the call and the put options to exit while you needed the liquidity most. And second is, of course, the bigger play, where SEBI says that the risk management and investment related due diligence process was not done well. So these are the broader 5 points around the violation as per SEBI.
Yeah, in fact, I was quite horrified. It's a pretty damning order if you go through it, in detail, because they've said things like, you have given out loans to people. You have not made investments. In some cases, FT has taken up 100%, of those issues. They've said you've not disclosed Macaulay durations properly in the portfolio statements and all. But all in all, I mean, it's a difficult road now for FT, but they're going to go the appeal way. They're going to go to the Securities Appellate Tribunal. How is this going to pan out? Is it going to be again one of those long drawn things? I mean, how do these things work?
So Sumaira, like you rightly highlighted in your opening remarks, there are three major penalties. First is not allowing a new issuance of debt scheme for the next 2 years. Roughly, like you quoted, 512 odd crore rupees that FT is expected to pay back, and 5 crore rupees of penalty, which is a monetary penalty. Now, in my opinion, if you look at it, FT as it is, in my opinion, would have not gone ahead and launched any new debt scheme. So that probably part of the penalty is not a trouble at all. In my opinion, the only trouble that FT probably sees in this order is the 512 crore that they are expected to plow back in the scheme. Now, generally, the way it works is very simple. FT would try and approach SAT for it. The first thing is they will have to convince SAT as to why should SAT accept this particular case or hearing from them. And once SAT has accepted this particular case, then of course FT's next step would be to try and bring a stay order on the operations of the order. Now, that is how generally it works out. I think we'll try and get more details as and when things unfold. But generally, while you try and approach a SAT, this is the process. First, you get the SAT to accept the order, and then you try and put a stay on whatever SEBI said, and then the next things follow thereon.
And, this is on the AMC level, right? Now, even on individual level, for a lot of people involved in the process, there are some very scathing remarks that have been made, right? As well, the order ends by saying that adjudication proceedings are ongoing now against CEO, the compliance officer, directors, etc. And, I would suppose perhaps a few others as well. Will this cast a shadow now on the workings of FT? Because while this investigation continues, I mean, these people are still actively involved in managing the schemes.
So, Sumaira, this works in a common pattern. So, typically what happens is when any of these things happen, the first thing that typically SEBI would do is do a forensic audit. Then you do a show cause notice. The third, what you do is what we've just seen, which is the adjudication. And then there is the final order that comes in. Now, what has happened in the case of the CEO, the compliance officer, or the directors, the final order is yet not received, right? And hence, we don't know the granular details of how it will look like. But if we can take some clue from what was done to probably Vivek and Rupa Kudwa, we'll understand that there can only be a monetary penalty like it has happened in the case of Vivek and Rupa. Because what we saw in Vivek and Rupa's case is it's not a Section 11 order which has happened to the AMC. So in my opinion, they should not impact FT current working or the schemes at all is because it's, in my opinion, going to be a largely monetary penalty on the directors, the CEO, or the compliance officers.
Okay, but what about the equity schemes? And I mean, this is a question that a lot of people have been asking for many months and weeks, and we've spoken about it as well occasionally. Is that what is the fate of these schemes? I mean, some of them are performing so well. Do you think investors are going to get spooked now because the trust deficit is only widening post this order?
So Sumaira, like all of us know that equity schemes actually move in a cycle. So had we had this discussion 2 years back in 2018, probably FT schemes were not performing that great at that time. We've only seen over the last 1.5 years that schemes have actually picked up. Now, if you go slightly deeper in it, you will see that since 2018, up till now, the overall AUM contribution is almost very flat. What do I mean is that they still hold, after the winding down, close to 10,000 odd crore rupees in debt and close to 50,000 odd crore rupee worth of AUM in equity. Now that the markets have gone up so much, ideally there should have been a positive M2M on the AUM where the AUM should have gone up. But if you see over 2018-19 till so far, the AUM is pretty constant, which means that the M2M impact on the AUM, which should have increased the AUM, which has not happened, there are redemptions. And this is no different than anybody would have thought, that there would be redemptions definitely. See, they've got a good pedigree. They've got a long standing in the way they've been managing equity funds, not just in India, but globally. But the point, like you rightly pointed out here, is majorly on trust. Now, in my opinion, that if everything falls in place, but you can't trust the way things are going to be managed with respect to your monies, I think you have a lot of other options to look out for, where along with people managing the funds well, you also have trust that things have not gone wrong in the past. So in my opinion, look, the pedigree is brilliant. They've been in the business around for a long, long time. But to a certain extent, for some time, there is this trust deficit, which is definitely going to be a major factor deciding which way the AUMs or the equity funds should move in their case.
Got it. Kirtan, thanks very much for joining in. I mean, we can go on and on, but time is limited. So thanks, Kirtan, for your time this afternoon. So that's how things stack up for now in the FT case. And perhaps in the next few weeks or months, we are likely to hear again from SEBI regarding where these adjudication proceedings have led to. With that, we're going to take a very quick break, but on the other side, we're going to talk about whether there is an opportunity lurking for investors in arbitrage funds. Bhavesh Jain, fund manager at Edelweiss Asset Management, will join in next. Hi, welcome back. You're watching MF Corner, and now we're going to talk about arbitrage funds. So, in the last year, every few months, this topic of arbitrage funds comes up because last year in March sometime we saw them give negative returns, I think perhaps for the first time, if not after a very, very long time. But now it appears in this recent note that I was reading issued by Edelweiss Asset Management that there could be an opportunity for investors that lies ahead. So what exactly is this opportunity? And also, for those who may not know, what exactly do arbitrage funds do? What do they add to your portfolio? So joining in to answer all of these questions is Bhavesh Jain, fund manager at Edelweiss Asset Management, who also manages their arbitrage funds. Bhavesh, hi, good afternoon. Thanks very much for joining in. So first things first, we'll talk about the opportunity in a bit, but first, for those who may not know, can you explain how arbitrage funds really work and what place do they have in a person's portfolio?
Thanks for having me here on discussing one of the topics which is close to everyone's heart in Edelweiss. See, arbitrage is a very simple product. It is like something we do in our day-to-day life. We buy something from a place and sell the same thing at a different place and try to earn the gap between the buying price and selling price. The same thing we try to do over here. We buy a particular equity stock in NSE cash market, and at the same point of time, we sell future of the same stock in NSE derivative market. So this is how we try to earn the spread by capturing the difference between cash and future. This is what is known as arbitrage.
Okay, so in very simple terms, you see, you harness the difference between two markets, and that is the return. Okay, what exactly is this opportunity? I mean, I know for in very layman terms, when the market is volatile, it's easier to arbitrage or more beneficial. But we've seen what a 900-point rally in the last 1 month. I mean, what is the opportunity that you see ahead?
In bullish market, when more and more people are extremely positive on market, like something what we are seeing for last almost 1 year now, where markets have actually doubled from bottom we made in March 2020. More and more people are taking this leverage opportunity. So you can see open interest on derivative is right now at lifetime high. It is close to 1,52,000 crore. That means more and more people wants to take participate in this upside journey of market by taking leverage position. And as an arbitrager, I am the supplier of that product. So if demand for my product goes up, that means more and more people want to go long on future. I am getting much better price because I am the supplier, and as a result, I am getting much better spread. And that is why I think this is one of the best time to look at arbitrage of funds, because not only on the post-tax basis, always arbitrage fund used to do better than liquid, but in last 2-3 months we are seeing arbitrage outperforming liquid even on the pre-tax basis, and then that outperformance is anywhere between 100 to 200 basis point. So this is one of the best time we have seen in last almost, you can say, 2 to 3 years. So this is a time where more and more people should look at arbitrage and try to gain maximum amount of profit from this opportunity.
Okay, I'll get to who should be looking at arbitrage, but before that, since you're talking about this opportunity that is there and perhaps the best in a very long time, will arbitrage outperform the other equity funds? I mean, I agree that there is an opportunity, but is the opportunity big enough than what I might be getting elsewhere? What is the alpha that an arbitrage fund can give me vis-a-vis, say, a large cap or a mid cap or any other equity fund?
I think the first thing, arbitrage, we push it, or this product is an alternative to your fixed income fund. Though for taxation purpose, it is an equity fund, but all practical purpose, this is as an alternative to debt fund. If you see why you call a debt fund like a fixed income fund or an FD like a fixed deposit, because your interest component is fixed over there or your coupon is fixed over there. Similarly, in arbitrage, your spreads are fixed. That means on day one, just taking an example, say I buy a particular stock in equity market and sell future of the same stock, and say the price differential is 1,000 rupees in cash and 1,010 rupees in future. So I buy cash stock at 1,000 rupees, I sell future at 1,010, and the gap of 10 rupees is fixed. Now, irrespective whether this stock from 1,000 goes to say 1,500 or the stock from 1,000 fell down to say 500, my spread or my income of this 10 rupees will not change. So it is as good as your fixed deposit or fixed income fund. So your spreads doesn't change with movement in market. And that's why it should not be looked at as an alternative to say your large cap fund or your multi cap fund or any other equity fund. It is purely an alternative to your, you can say, debt auction, which is like your say fixed deposit or your liquid fund or low duration fund. So you should treat arbitrage as an alternative to debt fund, and nowhere it is an alternative to your equity fund.
Got it. So what is the risk profile then of an arbitrage fund? And I mean, is it suitable then, you would say, for a conservative investor?
See, all set of investors will always have some part of their portfolio into liquid assets, which they keep either for some contingency, some emergency use. So by default, arbitrage can become part of each and everyone portfolio. It is like you are keeping some cash in say liquid fund to meet emergency requirements. Similarly, you can park that money into arbitrage opportunities like arbitrage fund. So all your conservative investors definitely can have a larger portion of their AUM into arbitrage fund. Similarly, a lot of corporate clients who don't want to take equity risk or are not mandated or allowed to take equity risk, they can also park their surplus cash or surplus liquidity into arbitrage fund, wherein their intention is clear that this money is for anywhere between say 1 month to 1.5 year. They don't want to take any equity risk, and they just want to get better return on a post-tax basis compared to your traditional investment option like say fixed deposit or maybe liquid fund.
So this is, you say, a low risk product?
Yes, 100%.
Okay, and does it carry, any kind? I mean, since you said that it's a replacement to FD investors, is there any kind of, interest rate or credit risk at all?
So for this, I'll just try to explain what is our investment profile. So for every 100 rupees which we get, 65 to 70% of that goes into cash future arbitrage. As I said, this 70% is 100% hedge, irrespective whether Nifty goes up by 20, 30, 40% or goes down by 20, 30, 40%. It doesn't change your returns. So it is as good as fixed. Then remaining 30%, or you can say 30 to 35%, goes into actual debt investment. A majority of that is in T-bills, or you can say GSEC, which we place with exchange for derivative margin. So again, almost 25 to 27% in T-bill or GSEC, which is sovereign. So again, you can say credit risk is much lower, or you can say as good as nil. Only 3 to 5% of our AUM is in cash or other short-term paper, wherein we have a clear policy at Edelweiss that it will be deployed 100% into AAA rated paper. And for transparency, we also publish our fixed income portfolio every Monday on our website. So you don't have to actually worry about credit or duration a lot in arbitrage fund, because it is not more than say 5 to 7% of any fund.
Okay, got it. Bhavesh, thanks very much for joining in and for explaining this concept of arbitrage funds and the fact that perhaps good times could be rolling in for investors in these schemes. With that, we're going to wind up on MF Corner, but do stay tuned. The market action continues with the team of Closing Bell.